When I'm on my deathbed and the curtain closes on my life, I want to bounce that last check. Rich people have unique ways of earning, investing, and spending their money. After all, they've got a ton of it, which gives them a much bigger sandbox to play with things. They can think about their legacy and if they should die with zero and give all their money away. They can give themselves permission to leave money on the table and walk away from opportunities. And they can use leverage to amplify their gains and their losses. Now, I by no means am mega rich. I just had a good career in Wall Street and then as an entrepreneur. And I've come up with 6 money rules that deeply impact how I live my life. I got to put these rules to the test with my wealth manager, Adam Katz from Corient. Adam's got a unique perspective because he works with many of the most prominent entrepreneurs in the tri-state area. He challenged my assumptions about spending. We talked about legacy, and most importantly, when do you stop thinking, worry about, and even measuring how much money you have? I hope you enjoy this episode of the Examined Life podcast.
So let's jump in. Before we jump into today's question, we are launching our next coaching cohorts. These are cohorts with similar professionals that are in career transitions. They're trying to figure out what the post-achievement life looks like. So come check us out at radreads.co/coaching. All right. So today's question is, what are your money rules? And we're going to mix this up a bit because I came up with 5, and there's 5 plus bonus. And we're going to go through them. And so let us kick off the first one. And Adam and I are going to discuss them. The first one is one.
And we haven't really discussed our answers on them.
No, we have not compared notes other than the questions. So the first question is, should you die with zero? And for context, this was a book, a book that was made popular by the author Bill Perkins, who's a former hedge fund manager. And he makes this argument that you should bounce, he kind of says in a pithy way, you should bounce that last check, right? And more specifically, the argument that he makes is the value of money when you're 90 is pretty low. And it's a little bit higher when you're 80. But it's really high when you're 50, really high, when you're 40 and then when you're 20 and so on. And so he comes up with he has this idea that, first of all, one of the ideas is you shouldn't leave much of your inheritance, right? Like it's kind of anti-inheritance idea, which is kind of, we should talk about that. And then the second idea though, is that, basically spend more when you have the health and the people to spend it with. And when you're 90 years old, you're paying for your healthcare and maybe a retirement home, then just, run that to zero. And there's one question that really blew my mind here when he asked it. He said, if you die at 85, how old will your eldest kid be? So the answer for me would be, 50. I'm not going to do the math on that. So somewhere between 50 and 55.
Well, what age were you when she was born?
I was, good question, right? I was 35 when she was born.
There you go. What school did you go to?
We're not going to talk about that.
Nothing but love. Nothing but love.
So yes.
Mine would be 56.
56.
And 85.
So you die, let's say you died at 85 and you have this inheritance and you give it to a 56-year-old, which is, by the way, older than you and I are both right now.
Yep, by a lot.
And so when I heard that, because I always think about giving money to my kids, I view them as babies. I don't view them as 3 years from their own retirement, right? When they lived their own life, they would have had adult kids by the time they're 56.
Yep.
And so that kind of really snapped it into place. So when you think of this die with zero concept, what does it do for you?
I think it's catchy. I think it's got a lot of nuance. So one thing that I would say is I always explain to people it's really different to be super wealthy versus having access and control over wealth for people you love and charities if you're into that. So I could use a pretty technical view as, I'd love for you to die with zero, but maybe there's a trust and a philanthropic structure that have tens of millions or hundreds of millions. So you could argue that those two things could be true at the same time. But I don't think that's the spirit of the
Yeah.
book, and I don't think it's the spirit of the concept, although that probably is more where I align.
Yep.
I mean, you hear me talk a lot about the marginal utility of a dollar for consumption will go to zero at certain asset levels, depending on
Yep.
your lifestyle. And after that, I tell people, what else are you going to do with it? And really all you can do is help people and things that you love. And I do like to encourage people to do that while they're alive versus posthumously. So, to me, it's an and where I believe you can absolutely ramp up your consumption, which is lifestyle spending, and your giving, whether it's people or actual charities. The problem is, to die with zero means you either just need to spend an insane amount, which our old fun movie, Brewster's Millions, shows you it's really hard to just spend a lot of money. Just a steak doesn't become more expensive because you're wealthier.
Yeah,
it's the same price. You can't pay more than the $100 at the best steakhouse. If you're a billionaire, you got $1,000. So what's weird is there's just certain things that you can't keep spending. So then to me, it really pushes into giving. Again, whether it's familial support, friend support, or charitable support. And again, those are daunting things. So, the view that I have is it should be an and, not an or. But you shouldn't give up that joy and memory making with your family, with your spouse, with your loved ones, with watching impact, with charitable for the future. And I think that to me is a really, really important thing, that if you're doing that and there's money left, whether it's in a trust, it's in a philanthropic structure or not, I think you're embodying that concept. Because I would imagine that his spirit isn't anti-inheritance. It's maximizing for inheritance in lieu of your lifestyle.
Yes. Very well said. Very well said. And I think you're spot on. I think he actually has a specific quote, whereas you want to create as many memory dividends as possible. But I completely agree that there's only so much you can spend on. That being said, I will kind of time out here and say that the people that you work with tend to eventually land in the 8-figure land. And I would say that people,
not 9,
apologies to anyone listening. But I
not
think
my
that
money.
The listeners, and myself included, would probably land in the 7-figure land, maybe creeping up to 8. Like, this is like if they continue their track. And so on. And so, but I do think that one thing that I know, that I'll just speak for myself, right? I have $5 million. And so, but I don't have a lot of equity value in something that will explode to the upside. One thing that I know that gave for me was it gave me permission to spend more today. Right? Because if I think of my life, there's, today's spending, and then there's like whatever's left over. Right? And whatever's left over, I actually, and we should talk about the inheritance question. Like, Lisa and I don't want to leave much money for our kids. Like, I don't know. I have no idea how much we'll die with.
I would like to talk a little bit about that, but keep going.
We should. But basically, we have said that we want to basically help them with a down payment, like all education and a down payment on a starter home, right? Which, with assuming that I continue to work and be smart and invest intelligently, there's going to be a lot more than that left over at the end of the day, touch wood.
Right.
And so die with zero for me gave me permission to basically spend that delta today. So it was much less about the actually dying with zero part. But it was more like you don't have to get the line to keep going up.
I couldn't be in more agreement with the concept. I think that because of what you highlighted, the people I tend to coach, they just can't outspend the growth over many, many decades. And so I do push very hard on people living what I'll call a frictionless lifestyle. I have people push back on saying they think friction's good. I would debate that, but a frictionless lifestyle where you're getting your time back, as we talked about last time. I'm all about using financial wealth to access real wealth, which I think is time wealth, autonomy wealth, and health wealth. So as long as you're doing all of those things and you're giving while you're alive, which I think sets an amazing example for your kids, not only talking to them about the numbers, which, I feel passionately about, because your kids will know everything that you spend because the internet tells them. They're only going to know what you give if you tell them. But not only do you want to give them money, you want to show them the impact, bring them to the places that you're helping. This is what I do a lot with Evan and Alyssa, who are, turning 18 and 14. So they're sort of in a zone where they get it. They understand the numbers. But the thing that I bring up, and I know you and I chatted about this a little bit, that I think is so related, is this sort of goes into the inflation concept. Because when people get worried about inflation, and I start running these models and I show people, and by the way, part of this is compounding. So if you're 35 years old and you make, $25 million, which is a lot of money, the likelihood is, you or your spouse will live 60 years, 95 years old. And even at 6%, that money will double, every 12 years, which is 5 times. So 25 becomes 50, 100, 200, 400, $800 million. Now, inflation will eat away at what that really is. And we can joke that maybe you won't make 6%. But the point is, if I said to someone who had 2 kids and said, are you married to both of your kids getting $400 million when you guys die? People are like, of course not. I said, do you care if they got 50 million, 100 million? Assuming that they literally wanted them to get everything that was in the account, not managing to an actual number.
Yeah.
Then I say, well, the only competition then for you living an amazing lifestyle and giving while you're alive is a terminal value you've decided they need. And no one ever has answered that and said, no, there's a terminal value and I'm willing to sacrifice memory making today or being generous today. And I think that's where I really do quite align with the concept. But I guess because of the values that I believe you can live that same lifestyle without foregoing any give ups, but you don't die with zero, partly because the numbers are so big, and partly because, as I said before, with an estate planning nerd brain, I'll have you die with zero personally, but I'll have a lot of the wealth outside of your estate in some estate planning structure.
Yeah. And so you brought up an interesting point there, and you went quickly because we're math geeks, but you used the rule of 12 or 7. What is it? The rule of 70, which says
rule of 70. Yeah.
Which
you
basically
did 6 times
says 12,
72. It's rule of 72.
Every 12 years, if you make 6%, your money doubles. Right. And so if you use like a very simple example, like when I left Wall Street at 35, at $4 million, at 47, it would be, if you cover your living expenses, let's use 5. 10 years later, you have 10, 20 years later. So at 65, you have 20 million. 10 years later, at 75, you have 40 million. Right. So that's the compounding.
The compounding is huge.
That's
just hard to get our head around it.
And I think that some of our listeners, so to bring it back to some of our listeners, like they're hearing these giant numbers, and the point isn't less about the giant numbers, but again, like if you're covering your costs, your living expenses, and you have some corpus of investment, every 12 years that thing's doubling, and that's assuming that you don't inject more money. And look, people are going to debate inflation and bull bear markets, whatever. But on average, and that is a that is a real engine of growth that I forget because I've been living off.
Well, because we're also, when you're in the early phases of compounding, it doesn't look so extreme. If you zoom in on this part, it's just this. It's those next, the back half is where it gets so parabolic. And I think that's, again, our human brains, as mathematical as we can be, compounding math is very hard to get your head around because our experience behind us tends to look linear. Because even if it's starting to be parabolic, think about the first 10, 20, 30 years, it still looks more like a line than a parabola. And so I think it's our brains see linearity and can't see the parabolic nature of things. And so, but I really, again, I think conceptually, I'm not totally misaligned with it. I think that I don't know if people's goal is to actually leave nothing versus just don't leave anything on the table as it relates to you living. And I think that, to me, I'm fully aligned with. And I think you can, the proverbial, you can have your cake and eat it too.
So what do you think of kids' inheritances, right? You're an exited founder. Like I've already established that there's going to be something for our 2 kids. How do you think of you and I both grew up middle class, lower middle class, maybe.
It's all
Um,
relative. My dad
but
died, $133,000 to his name. I
oh
guess
yeah,
people would debate what that means.
yeah, yeah. But how do you think of giving, like how you will give, or how should one think about how to give cash to
Yeah.
their kids?
So,
And Die with Zero would say, like, you really want to, the kind of optimal point to give them money is, between 20 and 50.
Mhm.
But at the same time, I think people like you and I and our listeners are like, man, part of what made me who I am was that no one showed up and gave me a random down payment for, I had to fucking fight and kill for that down
Yeah.
payment.
No, I know.
And so how do you think about that? Someone, Joe Hudson, one of our guests, said, you can give someone resources, but you can't give them resourcefulness.
Yeah, no, I like that a lot. I'm not sure yet is the reality. Is I don't really know. I had owned half my company in a trust. Sort of, I do trust for a living, so it'd be weird to not eat my own cooking. And so, just with compounding, there'll be a lot there, way more than Dan and I necessarily think is the right number. But I don't know yet.
Yeah.
And I think it's hard to know when you're in your 20s, 30s, 40s, maybe even 50s about how you'll feel. Also, remember, your kids could end up surpassing you. So
Right.
fair and equal about inheritance are not synonyms. Often they get confused as them. And so really, the way I look at it is, I grew up in a way where I felt pretty independent financially by the time I was, I guess, 20, 21 when I graduated school. I found out my dad had loans on school and I paid them off for him as long as my own loans. I was fortunate to be able to do that quickly. But I was really on my own from the beginning. And I don't feel bad about that. And I do think that helped with my grit. But I also do think there is a level of support for kids that helps sort of avoid the noise. If you asked Evan, my 18-year-old, he'd say, my dad and my mom just want me to do what I love. And that might mean that I don't ever get to live quite the lifestyle that my family is, but I know I'll be okay. And that's sort of what we've told them is that, you're never going to live in a roach infested apartment like I did my first one. They only came out sort of when the lights came on, which is sort of scary and creepy. And again, I don't feel bad for myself, but like it was pretty gross. And, my parents couldn't do anything to supplement. And, I was, making a reasonable amount of money, but I feel like to me, there is a way to help your kids. But as you said, that's along the way.
Yeah.
I care way more about setting up ways that education and other things are always fully funded for probably quite a bit of time. And I do think, though, that if you bring the family into the fold as it relates to how you give and help other people and organizations, them inheriting the money or inheriting the stewardship of money, you could argue could sort of be somewhat fungible. So, they could be the steward of a foundation or a big donor advised fund and give away the money, or they could have it in their pocket, but already have ingrained in their DNA, having watched you, that's what they're going to do with most of the money themselves. But maybe you want to give them more optionality. So, there are ways to have your cake and eat it too. In this example, where, you could set up a structure that you could decide what to do in the future. But in the near term, you might say, hey, I'd rather most of it not go to the government if it doesn't have to, or the state that I live in. So I think there's a variety of ways to do it, but I do believe in leaving my kids with reasonable means, but probably not what it would be if I didn't slow it down through additional consumption and additional giving through our lifetime. The compounding would be too great.
Yeah, I love that. All right, let's move to the next question. One of my favorites. There's question 2. There's no such thing as the number.
Oh man!
Right? Everyone has the number.
You've loved this one forever.
Everyone. So for those who are unfamiliar, there's this number where it's like FU number, or I could do whatever I want. And it's funny because you see these polls on Twitter all the time. It's like, what's the number? And you'll literally see everything from like $2 million to $500 million. And so I bring it up.
And unfortunately, hold on, in that community, it's got the obnoxious nomenclature of bucks.
Oh yeah,
I need $10 in the bank. So pretentious,
man, it's so douchey. And so, but I bring it back in a more serious way, because I think that there are people who are probably like myself that were more on the W-2 path,
Yep.
kind of high income, maybe partner track in a law firm and
Yep.
so on. And they're like, when I have $4 or I did it, when I have 8 million or 2.5 million, then I can go and quit.
Yep.
And then they do these like spreadsheets where like consumption and investment growth, they always forget
Yep.
taxes. It's actually really hard to forecast taxes on your own.
Because the reality is the DIYers do it in literally an Excel spreadsheet. And
Yeah.
unfortunately, you do need a software which it'll model taxes, which are always grossly overstated because of the assumption of turnover and capital realizations that you in reality just wouldn't do. You're not going to keep selling your SPY that you've held on to since I met you. Right?
Exactly.
But the models will assume you will. But anyway, keep going.
And so, you know, and I see this with my coaching clients all the time. They're just like, oh, I'm going to stay for one more bonus. It's an extra buffer of $500,000, whatever it is that buys me 2 more years of living expenses.
Yeah.
And then there's also the running joke, which is what's the best time to leave a high paying job? After next year's bonus, right? So I'm sure you've talked to people in that boat. I mean, I was one of them. This concept that there's this one number, and again, really more at a W-2 lens. How do you help people kind of wrestle with that number concept?
Yeah. And I would say that what I find, and it's really, you know, I'll find it sort of more in my personal life, even more than my professional life sometimes, whereas I think people do math when it tells them what they want to see. People don't do math when it likely might not. So a lot of times I'll sort of like watch people live and, you know, I have a sense of what maybe they make or not. And I think that it's daunting for someone to use one of those models to tell you what terminal value at the end of quote unquote not having a job, right? And I think having a job versus working are also not the same thing. I think a lot of people work way past having a job, but they do it way more on their own schedule. So part of that, Kay, is that, you know, you get to this point where you may have a terminal value, but you're supplementing it with an extra $100,000 a year, $200,000 a year of consulting fees. But there is a number.
When you say terminal value, you mean that's just the number, right?
Right. So this is the thing. I think that there's a math equation, but it has so many variables.
Yeah.
So one right now that I think is really interesting is people are getting fooled by literally putting the money in the bank and getting 5%.
5% interest
It would have
rates.
been so hard to get 5% 2 years ago without taking some interest rate risk, i.e. duration, with your fixed income.
Yeah.
And you would have dealt with price volatility when rates moved. And obviously with rates spiking the way they have,
got annihilated.
You would have gotten annihilated. So I think people have gotten lulled, but I also think it's helped people have a different perspective. So, you know, I will shift a little bit on just sort of a monetization lens where you may have thought, wow, I need, you know, $25 million or $50 million of an exit to be able to do what I want. And then I would say, well, right now, every $10 million you lend to the government, you get $40,000 a month. You know, 5%. It's crazy. And then people are like, whoa, I can stop tomorrow. I didn't realize that because I never thought about the return profile on a big denominator. So I think part of what I try to coach people at all these levels is what is the lifestyle you want? We got to start there.
Yeah.
And sadly, a lot of times the lifestyle people are leading, although this goes back to our die with zero, it would be hard to maintain with it. Like it's scary. Like if you're making $1 million a year, you need $20 million in the bank at 5% to make $1 million. And whoops, you got to pay taxes. So the person,
and to add to that, the only way you do not get 20 million in the bank by being a W-2 worker.
No,
in the exception of like working at Citadel,
if you make,
basically.
You make $1 million a year, you keep half, 500 grand. So even if you try to be really prudent, you save 200 grand at best a year.
Yep.
Takes a long time to get up to those levels. And I think that's where it gets confusing. Whereas I think people don't do the math. I do think there is a number that technically works for people. I think it's usually, I don't know, 50, 100, 200.
It's way too
higher than people realize. And therefore it becomes this elusive, unattainable number. And I think it's definitely a daunting concept for people. But I do think that when people really understand lifestyle, I try to really push as you are. There's like these golden years of like amazing living and just living in general. So, you're in your 30s or 40s, you hopefully have another good 30 years of really healthy, amazing, active living. And then you may have just another 40 to 50 total of living.
Yeah.
And, I don't think people want to suddenly be living in a tiny little room in some home after having lived in, a mansion and have a second house and travel a certain way. But I'm guessing you wouldn't feel so bad if you were by yourself at that point and your spouse had passed, not to be depressing, and your kids and grandkids came to visit you, but you had 20, 30 years of amazing memory making. So I do think there's a number, but I think for most people it's totally wrong. And I think for most people, the number is probably way higher than they think it is, which I think would only become depressing almost every day because it's unachievable.
Yeah, I think you're spot on. There's like, if you want to live risk-free, we used $1 million. People are like, who has $1 million? Family of 4, private school in New York. You're probably pushing $750,000 in living expenses.
Say that one again, by the way, because I don't think 60 grand a month.
60 grand a month. Okay. Yeah. But to live off of the interest, the pot has to be so big. But here's the trick. This is the trick that I figured out, is that the pot for me is not as big. But if you could just make a little bit of income.
That's the trick. That's the
it changes
people don't understand. Like if you said, hey, I want to hit the eject button at 55, 60 years old, and I'm going to have, $8 million in the bank, which, if you're earning well, your 401k should have many millions of dollars by the time you're 60, 65. You're not, obviously can't touch it quite yet, but you really would be surprised on the compounding of a well-funded 401k because again, it's those back years, you get to $2 million by 50.
Yeah.
And then suddenly it's $4 million at 60.
Yeah.
And it's $8 million at 70. So, those numbers are reasonable. But Kay's points, dude, that's the most important point, is if you could just make an extra couple of $100,000 for another decade. And I know that's still a bunch of money, but if you're a high earner, the idea of you could sit on a couple advisory boards, do some consulting projects, and you're working, but you don't have a job.
Yes.
And that's a really different feeling of empowerment.
Yes. And I'll flip that even further, where for me, I work, 40 hours a week, pretty low stress, love what I do. I could see myself hosting this podcast into my 60s because I'm just talking to my friends. Right. And so if this podcast generates, $5,000 a month, that's $5,000 a month that doesn't need to be generated off of a corpus, which if we reverse engineer that corpus is actually a pretty big number.
That's the people, because they're like, well, what's 100 or 200 grand to do? I'm like, well, not only, but you're only spending $500 a year. So it's huge. It's 20% of your spend. And the amount of extra money we would have needed in the bank with your number would have been X. And people are like, whoa. So you have like this synthetic thing. You might be able to say, wait, that extra 200 grand, I would have needed, let's say every $1 million is making you right now, whatever that is, 5%. So 50 grand.
50
so you're
grand.
like, whoa. So I would have needed an extra like $3-4 million.
Yeah.
And if I just did that for a decade, holy cow.
I know.
And I think, again, people don't do the math.
Yeah.
And hopefully this is helpful for some people with framing.
Yeah. And just because I know we're both spitting out math numbers really quickly, but basically to TLDR it's when people, they want to live off the interest. Well, the interest is, it was like 1% 2 years ago. So to live off of interest, you need such a gigantic number. But if you just worked a little bit, you could actually make more than that interest amount. And so it kind of, it screws up all of the math of the number. And we haven't even hit, and we'll save this for another conversation, but the hedonic treadmill, which is there's this, I've said this on the podcast before. Actually, this new study came out. They asked people, and the numbers were lower than I saw in the past. They asked someone with $100,000 a year earn in W-2 income, how much would you need to be happy? And And it was like $100,000 a year, $200,000 a year. I think it went up to $500,000 a year.
Mm-hmm.
And across every single category, it was 50% more.
Yep.
And so in addition to the number being hard to calculate, once you actually get to it, the goal line would move really quickly.
Yeah. And Kay and I would imagine you'd agree with me, buddy. We're not immune to this. I do this for a living, and you have your own thing, and you're like, oh, but if it was there, maybe I would think this way. And I'm like, what are you doing?
I know.
What are you doing?
I know. All right, let's shift to
What's next?
Money rule 3. Lever it up, baby. Money rule number 3. Lever it up. Okay, so I'm going to give a little backstory.
Yeah,
because even though Adam is my advisor, we don't. This is kind of more just something that I've just done on my own. But as of 2 to 3 years ago, and again, this is probably part of a zero rate environment where money is free to borrow. I basically decided that I'm going to stop carrying any cash, and so I've gotten to a point in my life where
makes that more clear for people. Okay. So like you'd open up your statement, or you go online, and what does the allocation look like between cash, stocks, and bonds?
Yeah, so let's take a really easy $5 million portfolio.
Right,
it's $3 million in S&P 500, $1 million in private equity, but more equity like risk. And then the rest in crypto, angel investments, and so on.
So people would ask you, which is, of course, the fun part is, wait, how do you pay your bills?
Yeah. So here's how I pay my bills is that my business closely covers my living expenses. Not exactly, but close. So that's part of it. And then my some of those investments spit off cash. So I get some cash distributions. So that comes close, but it's very lumpy. Like I might make half of the year's revenue in one quarter, and it might be towards the end of this year. We made 50% of our revenue in the last 3 months of the year. So then I'll go in and basically borrow. And for those of you who don't know what probably need to do with a margin explainer, but margin is when you borrow money like a credit card of sorts or a bank loan, where you can go and it's collateralized by your liquid investments and any type of investments. But for me, it's liquid investments. And I basically say, hey, can you wire me $50,000? And someone on Adam's team, it shows up, like $50,000 shows up the next day. And then I'm paying interest on that money. And again, the interest rate fluctuates. When I started doing this, it was, I think, 1.25%, 1.5%. Today, I think it's probably 7%. Or so.
It might be a little bit lower, but it's much 6 or 7%. 1.25%.
But I never keep cash because I either get it in these lumps or I borrow it against margin. And then I have these rules on how much I'm willing to let myself borrow on margin, which is not that much, right? So it's like, 10%, 20%, 10, 15% of the portfolio.
Right. And that's an important thing that maybe explain to people about sort of that loan to the value and why you're comfortable with that based on the kind of investments.
Exactly. So the risk of margin loans, and again, not investment advice, the risk of margin
definitely not investment
loans
advice.
Is that if the thing that you're using as collateral, which in this case is shares of S&P 500, if it falls, look, we won't give the specific, but if it falls, the bank can then say, whoa, too close for comfort, start selling the S&P 500 shares to pay off the loan. And so generally it's 50% is that threshold, but I want to be nowhere close to that 50% threshold.
So what you're doing, it's a case saying, hey, I would need, a 6 standard deviation event in the S&P for me to get, the infamous 2 words, a margin call.
Yeah.
And be a forced seller is what Kay is saying. Is I always say volatility is not risk unless you're a forced seller at a bad time.
Yeah.
And being in a margin situation, they'll force sell you at literally the worst time you'd ever want to sell the stuff.
That's how it works.
Exactly.
Yeah.
But keeping the loan to value gives you a lot more flexibility.
Exactly. So I have a big buffer. I have a big buffer, and I use that and I invest that buffer. So if I'm borrowing 15% against my portfolio, I'll invest it in lower risk kind of credit funds. I have a real estate fund. Some of it, again, I'll use to like bridge myself, but bridge my income. But I'm not like borrowing that money to, like Lisa lost her engagement ring at a hotel. I'm not borrowing money to go buy in for consumption. It's more for cash flow management.
That I think that's the important thing, and people always ask me, wait, you always talk about mortgages. Don't your clients just pay for their houses in cash? Why would they ever have a mortgage? Because part of the American dream is to buy a house. The next part is to pay off your mortgage.
Yeah.
And it's a very linear decision. And obviously rates have been all over the place. So maybe it feels less intuitive to people. But I still think inertia tells you I pay off the mortgage as fast as I can, so I own it in cash. And, we pretty much, none of our clients, including myself, you buy your house in cash because you can, and then you actually take the mortgage back. And people say, well, I don't get it. Why would you have a mortgage? And you're saying, well, if I think, as Khe was saying, if I think I can go put it somewhere else where it can make me more money, I'm just playing, a spread game. I've got a fixed cost of capital for a decade. You take a 10-year interest only mortgage, you have zero rate risk. The only risk you have is if you don't pay your mortgage, then eventually they could foreclose on your house. But other than that, unlike the issue Khe was saying of a securities-based loan where the S&P could go up and down, your house value may go up and down, but it's irrelevant for that fixed period depending on your mortgage structure. So almost every one of my clients has mortgages, as do I, and they take that money and they go put it somewhere else that they believe will exceed that cost of capital. And not getting into tax advice, because we wouldn't give that on this either, in theory, you could likely trace the interest expense from either that mortgage or even that margin line and actually deduct it against the income you're generating from it. So, leverage is a weird thing. I mean, every company has leverage, but on a personal level, it tends to be thought of as a pretty negative thing. But this is, I think, intentional leverage versus forced leverage are radically different. Most of this country has forced leverage to buy that house. They literally have no other way to buy the house other than the mortgage.
Yeah.
Whereas if you have means, you actually take the mortgage because you want it as just a cheap source of capital. And as Khe is describing, in his mind, if I have a place to go put it, which has to do with access and probably some level of smarts, a little bit of luck too, I might as well clip the spread. And it's better than me keeping cash on the side. But I think leverage is, is definitely something that most people are generally uncomfortable with. I think that's one of those early learnings from childhood that most people cannot untether themselves from. But, math is math. And risk is risk, which I think sometimes there's way more risk than people realize. And then I think sometimes there's a lot less risk than people realize.
Yeah. And I'm glad you brought up that there's a story in the US. And this is kind of, and it's going to sound like somewhat pretentious, but in the more kind of traditional mainstream financial advice, Dave Ramsey and like debt is bad. And then, but when you get to the kind of the higher net worth, debt is another tool in the toolkit. And so just to make that really clear, be like, well, isn't debt bad? I'm like, yes, if you're buying a TV on your credit card at 16% interest rate, that's very bad. If you are borrowing money collateralized by your stock portfolio at 1.25% and investing it in real estate, probably not. It's still risky, but it's a very different game, and that's like notwithstanding the tax advantages and so on. But I tell this story because when I tell people this, smart people, they're like, "You're fucking out of your mind. Like you have
it's a little extreme, but again, as long as you're managing the loan to value the way Khe described, he should be safe. But listen, I mean, scary 3 standard deviation events do happen. But even in the last decade, when you've seen some big drawdowns, it's 20%, 30%. Khe sort of saying, hey, I don't think it's going to come down 70, 80% in 1 year. And probably has some other resources to buffer that if necessary. And again, has other things to do with the money. So again, probably a little more fun when it was 1.25, not as fun at 6 to 7.
A little painful at 6.5%.
But still, the philosophy is, I think, smart. And again, because most people I'm dealing with come into something so sudden, when we talk about this idea of, you're gonna buy the house in cash and you're gonna take a mortgage after, and here's why from a tax perspective, it's not intuitive to people. Like, don't I just want to own it in cash? I'm like, well, you can. No, I don't care. That's great. But here's why you would do it the other way. And people are like, oh, and they're like, so I have no risk of the rate changing for the 10 years. At the end, I can just pay it off. I'm going to go invest in stuff that I think's going to earn me more than that. Because I think about this, I've locked in the rate. Think about what happened over the last few years. People have mortgages at 2-3%. They can literally go lend it to the government and get 5. So they have a fixed rate of the cost of capital, and literally can sit in cash right now and clip 2-3%. So that's an unusual market dynamic, but that for many people right now, that's what's going on.
Yeah, and that's why no one's selling their house. Like, who wants to give up a 2% mortgage, right?
Correct.
So, longer story. Okay, lever up. That was number 3. Number 4, it's okay to leave money on the table. This one, I shout out to my friend Ali, who's a YouTuber who made a video about this concept. It's kind of brought it top of mind. But we've been talking a lot of, there's accumulation, right? And I think this is something that many of our listeners start to realize is like, you don't have to optimize and maximize everything. There's this concept of maximizing versus satisficing. So maximizing is where everything is optimized. So, if like Allied Bank has the highest rate and I'm at, Marcus or Chase, and it's not, I could get an extra 15 basis points, move all your balances over and to capture that extra spread. And then, so that would be maximizing. And satisficing is like, look, the rate's pretty high. It could be a little bit higher, but I am going to be okay leaving money on the table. And so it really,
but why? So why do you think people that aren't willing to leave it on, like, what do you think is motivating them? And on the flip side, which I think is what we want to try to teach people, is the people that are willing to leave money on the table. Why? What do you think? What utility are they getting out of that lost money?
Yeah. So why aren't people? Let's start with why aren't people? What's going on? I think that maximizing, one of the things that I see happening, and myself included, is like everything turns into a game, right? There's a group of kind of achievement-based people who are listening to this podcast, who are probably your clients, that like they view life as a series of games, right? You and I met at a decathlon for Wall Street. Like, people had private trainers for this one-time decathlon event for, a bunch of finance dorks, right? So everything turns into a number of steps you do, right? How many likes you get on. And so, so I think that when
people know
you view life,
one speed.
What's that?
They know one speed.
Yeah.
Every dimension of their life, they have to win.
Yeah. And I think that there's a much deeper psychological thing happening there, is 100%. That a lot of, and I put myself firmly in this category, I like winning so much because as a child, I felt like I was always losing, right? And mostly because I wasn't cool and people didn't like me, and people didn't tell me how that I was special or anything. They were just like, yeah, you're just like another kid in the class, right? And so I think that when, a lot of achievement-oriented professionals that I've met, myself included, their starting point, how they see themselves, is I lack something. A lot of the times that comes from kind of the different like childhood experiences. And so when you lack something, you can fill the bucket of lack with a W, right? You could win a charity golf tournament. You could have a lot of YouTube followers, and you can watch your bank account go up all the time. And so I think that the reason why people feel uncomfortable is that a lot of those wins, that optimization is in their mind, is replenishing the lack.
I'll start reacting to some of this. Yeah. So I agree with you. And, when I meet people that are optimizers, I tend to sprint the other way because it's just not I don't find it's a fun dynamic. You feel like it's typically a person who they've probably gotten taken advantage of and never wants that to ever happen again. and they therefore feel like everyone's out to get them. So I think that's part of it. Some people might say that's sort of a bullshit response. I think it's just people believe, why shouldn't they optimize?
Yep.
Why aren't they entitled to optimize? Why aren't they entitled to win whatever negotiation exists? And I really do think about this a lot. And the most sort of day-to-day example I can think, although you're not doing this every day, is buying a car. I love cars, as Kay said. I never negotiate till the end. It's the utility of the last 2, 3, 4% is irrelevant to me. First of all, I like other people feeling good, but I get to sort of a number. It's funny. Once in a while, I get to a number in my head that I think sort of feels reasonable, and I get there too fast. And I'm like, oh, screw that one up. But I don't keep going. It's like the idea of staying an extra 3 hours to get another $20 off the lease to tell someone some artificial number. Oh yeah, I'm only paying $1,000 a month for it. Well, yeah, but what did you put down for it? Did you roll taxes?
Yeah,
it's so funny the way people act. So I watch that on the car. I feel like people talk about car lease payments, which is a big math formula, and you don't know any of the inputs. You're just hearing a number. But even if it is a number, people they want to win, and they're willing to wait the extra 2, 3 hours at the dealership and play the game when the salesperson goes in to talk to the manager, which usually there's no one actually in the office.
Counting to 100, right?
It's a crazy dynamic, but I feel like the leaving it on the table thing is a big deal. And I think the other maximization that I watch in my world is people really get focused on creating so much a maximization of tax mitigation to the point that they've created so much complexity in their life, and they feel, this is going to sound weird, they feel poor because they've created so many structures that they don't really have access to their money in an easy way. And those aren't people that I help architect plans for. I usually find them, and I'm usually impressed by what they've done. But I'm like, man, you have engineered your life in a way that you have optimized for the last dollar of taxation, but you've also optimized for this feeling of scarcity because you sort of overdone it.
That was the thing that I was going to say, is usually comes from a place of scarcity. And what I think people say, it's kind of like, it's like, oh, if I eat that cookie, then next thing you know, I'll be eating cookies for breakfast, right? Like there's like, you don't trust yourself, right? And I could see that in some ways, like, for example, like not drinking. Like I don't really trust myself with 1 or 2 drinks. And so we're just like, yeah, it's much easier to like keep it at 0, right? In that, but alcohol plays like, it's like, it has one of those powers on you. But I do think that there is this like, I'm going to, and I've seen this, you've seen this too, with like people who have tens of millions of dollars that they walk to an ATM fee to like avoid the dollar. And I'm like, dude, do you know what your time is worth? Right. But I do think that
I've seen people, they won't valet the car. They'd rather park 3 blocks away and walk in the rain.
Yeah.
Because in their minds, they're winning. I paid $1 at the meter, not $20 over there, to which, I'll go back to our fun thing around my 3 digits, which is like, do you really know down to $19 what's in your account, or even 19,000? Yet you somehow just decided this was, you won. The valet didn't win. They didn't beat you. You didn't get suckered in. Instead, you showed them, and you're soaking wet.
Yeah, it is. I do think that one thread of this is that people don't trust themselves. And I think that they see this downward spiral where if I valet once, next thing I'm flying first class, and then a year later I'm buying a private jet. It's like, no, dude, you're just valeting.
Well, that's that point where I said the compartmentalization versus the one speed. Like, there's certain things I guess I optimize, but I tend to be like, when I see my utility curve starting to go right here, I stop. Other people just believe at some point it's going to go up a little bit, maybe a little bit more. Maybe it's there somewhere. And I'm like, no, right here, it's done. It's over.
Yeah.
And again, you just sort of have the you don't have your FOMO, you don't have the scarcity. Once in a while, you're probably right. If I had kept going that extra 3 hours, I would have gotten more money, and I guess I would have felt maybe good. So I do think that the scarcity mindset, I think it's feeling like I'm not going to get taken advantage of. I'm going to be on the other side of that. But doing that in one speed has got to be exhausting.
Well, let me ask you this. I love that one speed analogy. Like with your clients, I'm sure, in general terms, you see someone who exits and they're probably like 40, right? Life-changing money, never need to work again. And I know this type, not as well as you do, but oftentimes they go start another company, a year later. And sometimes I ask myself, is the source of fuel, is this a healthy source of fuel? Because sometimes it's like chip on the shoulder, like, oh, this person wronged me, like this competitor fucked me over and I want to prove them wrong. Or so there's this like unhealthy source of fuel. And then there's a healthy source of fuel, which we know the type, like myself, in the sense that if I'll keep doing this, you're going to have to carry me out to stop doing this, right? I'm doing it because this is fun, not because of what this brings me, this podcast or RadReads. How do you, because I think that there's a lot of leaving on the table angst in that juncture. What have you observed in that juncture?
So it is fine. I would say you're right. On average, the people I work with are serial entrepreneurs, not small business owners. And so the serial nature of serial entrepreneur means you're going to keep doing it. Sometimes I meet them when they're on their second or third, and those first two weren't that life-changing number. They were nice hits, but not quite the life-changing. And usually what's going on is they got fucked on their cap table. Maybe some prefs came in. They didn't understand when they were raising capital how dilutive it was. So sometimes there's a little bit of that chip. And I would argue some of it's not even a chip. It's just, hey, I made $4 million. It's awesome. Probably should have made 14, which would have felt really different. But like, I think I know how to manage the cap table. I think I'm really investable, meaning people want to be with a winner. And I did show a big win. I think I can get the next leg and get that 20, 30, $40 million hit, which really is that. So I do think a lot of times
for a layperson's perspective, what Adam is saying is that people forget that when you raise VC money, the original founders get really diluted. So even if a company sells for $500,000, there are many situations where the founder leaves with like $5 million, which is still a great number. But when your company that you founded sells for $500 million and you leave with 5, you may have a chip on your shoulder.
Yeah. I think what I find though is that part of why people will start something again is they're really not sure what else to do. And I think the idea of being a coach or just an advisor doesn't feel fulfilling enough at first. So I feel like it's very rare you don't go try again at least once. And I don't think it's as much for always optimization of money, because the utility of money is zero at that point. I think it's the sport. I think it's the hobby. I think it's the passion, which I think some of those are all reasonable, pretty good motivators versus really the optimization of the dollars. But, again, I really try to coach people on, is there non-financial utility to your exercise? And that is the real true north of a lot of it. And is any of that detracting from the memory making? And is it detracting from your real wealth? Again, health, time, autonomy. Because how weird would it be to have enough money that you don't need to do anything in particular, yet you go after another thing at the real, detriment of memory making with your kids, your spouse, your parents? Like that seems like a really weird decision. And I know it's hard to not keep charging hard, but like, what are you doing? Like, what was the point of all this if you have this optionality and you're not using it? And I tell people the problem is that there's such a one-dimensional view of success. I joke coming out of the womb, but at least coming out of college, it's one-dimensional around this money thing. And I think that for so long, when people ask you how you're doing, you respond to how your job's going. Like, what a weird Pavlovian reply. And I think that's part of it also, is that people forget, like, wait, I don't have to do this anymore. How uncomfortable is that? I don't even want to say it out loud. And maybe my actions on their own by not going to do it again or saying out loud, I don't have to. And I think that's really uncomfortable for people. So I think there's probably a couple of other motivators, but I do think you're right. There's definitely some that just want to keep going, to keep going. And by the way, there's some, and I won't usually engage with people like this, where they're actually trying to screw the people coming into their cap table. And that's the real optimizer, which is, that's where you see behavior that's definitely not aligned with money.
Starting a company, starting a venture-backed company is freaking hard, and it's you have to give a chunk of your life away. There's no way around it. Because to get an investor back that screwed you, like, wow,
it's crazy.
But no, it's crazy. All right, we are on number 5, which actually could be related. Return on hassle is greater than return on investment. So simplicity rules. Maybe I'll start with a story.
Yeah, you go.
I have what's called a self-directed IRA, and that lets you, it's a kind of like an IRA type 401k type vehicle where you can invest in private companies and private funds. And
I'm glad you defined it, because when people hear self-directed, like, you mean you just decide what you want to invest in? I'm like, no, it's like a legal term within ERISA, which is retirement accounts. So anyway, keep going.
So I have this, and so I can invest in private funds and things that my friends do and startups and things like that. The problem with this self-directed IRA is that they are stuck in the 1900s, the way they process paperwork. And so it is the most mind-numbing, like they keep having to call you, but it's in the middle of the day. And when you're on meetings, they don't, you have to sign things by hand. You can't even take a screenshot. You have to you can't PDF things. It's so fucking annoying. And if I'm going to make a private investment, I'm expecting to make a higher return that I could make in the public markets.
Yep.
But I'm this close to just shutting down my self-directed IRA because I don't fucking care. Like the amount of paperwork I have to do for a $50,000, $100,000 investment, I'm just like, I'll just buy the S&P 500 and then call it a day. And so return on hassle. So yes, this goes back to leaving money on the table. This is a related point. But return on investment is missing a critical variable, which is how much brain damage is taking place in this. And this is why I feel so blessed that my primary wealth engine has been investing in the S&P 500. Zero brain damage. Zero brain damage on tax season. Zero brain damage when it's time to report. Zero brain damage. I don't even sell, but if I had to sell, zero brain damage to add. And I'm just like, thank God. And yes, I could make more on a private investment, but
maybe
maybe, and I have to fucking send a fax,
Yeah, no, I like this a lot. I mean, we do help with a lot of, different types of investments outside of the S&P, because most people can't handle the volatility of the S&P on a big denominator. Which we could have a whole discussion about that. But, being down 30% is different than being down $30 million when you just got 50. So I think that I try to coach people to have their money enable them and not distract them. But the return on hassle is interesting. A lot of founders, when they have a big exit, I think are enamored with being a serial angel. And I really push hard on this. I want a sandbox. So, hey, here's the amount you can do. But if you're going to do it, I need you to act like a venture fund. I need you to make X amount of investments in the next 18 to 24 months. Because I need you to create a vintage. Because how could you possibly think you're any better than anyone? You make like 3 investments. So then they're like, oh, that's a lot of work. And I push and say, unless there's a non-financial utility to the investment, it's probably not that worth it. But it takes a little while for people sort of like you did. And I think it's an analogous sort of dynamic of like, it was sort of a cool idea to do all this out of this pocket of capital that I don't really look at because I can't go to dinner with it anyway. And it's so long-term and it's locked up. I might as well put in investments that are locked up. Then you start doing, you're like, it's not really worth it. And maybe there's some non-financial utility, but there's way more non-financial annoyance. And so I find a lot of times, I do see that, when people are looking at these types of things, they don't really understand the hassle. Same thing with when people get really complex around different trust structures. It creates a lot of layers of complexity. And again, for what, right? And again, it could be because you're an optimizer and you're willing to deal with it. I think there's probably some decent correlation in these things. But I think this is a big one. And I really try to coach people on simplicity of investment strategy. That doesn't mean it all has to be in an ETF like the SPY. S&P 500, but it definitely, you don't need to have 150 line items. And that's what starts happening is people start, and then you start you have to collect, especially if you're doing private investments, they don't have what's typically called a 1099, which would be your brokerage sort of tax reporting.
Tax form.
They have something called a K1, which if you've invested in anything private, you get that. Well, the problem is you suddenly doing all these angel investments and all these funds, and suddenly you have 120 K1s, which first of all means your tax bill is tax prep bill.
Yeah.
Like your accountant's probably going to be $40,000 a year, which you're like, oh, I didn't think about that. Forget about the hassle. That's like some cost that I didn't even think about as a drag on this portfolio. And like you got to wrangle them all up. So I think it's a really important one. I love the first time I heard you say it. I never heard anyone think about it the way you have. But I really do think people understanding like, okay, so the utility of that, let's assume you're right and you make an extra 5% on that one investment, which is only 1% of your net worth, but it takes up all of this time. Like, let's do the math. Let's do one of those models. Let's go out 40, 50 years. Do you care?
Yeah.
Does it matter? Is the utility of those additional dollars, does it matter at all to you, especially going back to the die with zero and things along the way?
Yeah.
So I think a lot of this is connected, but I think people misunderstand the hassle. I think people, again, are in this one speed of thinking they're doing it because they're going to maximize their returns. But man, I love this concept. I think it's something that should be really explained in a more sort of readily available fashion.
So people will do that with tax strategies, private investments. Are there any other kind of culprits where people kind of forget this? I'll add one while you're thinking about it. You see this with like very wealthy people, but then they need to hire. They have like a maid, a nanny, a driver, a cook.
Yep.
And then managing. We're in like serious like first world problems, but like managing 5 people. You then need to hire a family manager, which is like a whole level of complexity. I've had a few friends that are like, geez, what happened? I lost the plot on my wealth. It's like, I thought I wanted a driver. I thought I wanted a chef, but someone's got to manage them. It's not me or my wife. So.
Well, you know what I think actually happens there? I never thought about it this way until you just said it. So I think it's a great example, by the way. Again, rarefied air example, but a good example and one I deal with a lot is I think healthy ego sometimes gets in the way, meaning, I don't know, just use Uber all the time. It's not a driver for you, but it's like having a driver. Have a NetJets account, not your own plane. Have a service for handyman rather than having a full time. Use certain types of ordering rather than having a chef. Like there's certain ways you could hack your way into a lot of the same outcome with businesses that are already built on the service side. And will you pay a little bit more when you add it all together? Maybe not. But even if you do, as you just said, man, imagine the expense of having to deal with a driver and to deal with the chef and to deal with your plane and the crew and the upkeep. And you sort of just keep going on and on and on into these ideas. And I think that, that's where, again, your healthy ego could get ahead of you because those are all yours. You own them. They're exclusive to you. And sometimes there's utility to that exclusivity. On the flip side, sometimes it's bad. Like I'll find people who try to build their own what's called family office, where people are doing their accounting and some of their investing and maybe helping them with their charity and this and that. And you'll find out you're one of one client to them. They're sort of practicing on you potentially. Because you're usually getting someone who's relatively cheaper because you're trying to cobble this thing together on your own. And it's the worst. Whereas just go hire a few different service providers. And yes, they're not just yours, but no one's practicing on you.
Yeah.
But the healthy ego could get ahead of you. So it's a sort of cool topic that you helped us meander into.
Yes. Healthy ego for sure. All right. Last one. Bonus one. We'll do this one quickly.
Bonus.
Number 6. Bonus round. Number 6, stop checking your net worth. And so I'll give a little backstory here. There was this video there's this YouTuber, Emma Chamberlain. She's 22 years old. She's done really, really well as a YouTuber. And she went on a podcast and she said, I have no idea how much money I have. My mom watches the account. My parents watch the account. My manager watches the account. I don't want to know. I generally know what comes in. I generally know what comes out. And I don't want to be a prisoner to that number.
Right.
And the internet went crazy. They're like, you're going to get ripped off. This is how wealthy people lose it all. But I had a more nuanced take on it. I'm like, oh, you're free because you have opted out of this game. And again, it's a rarefied air game, but look, people are updating their spreadsheets every quarter, every day, to see, like, to watch the number. Again, it's the game. Watch the number go up, 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 up. And you're just like, fuck it. This number, as long as I can do X, Y, and Z, which for her is, she lives a nice life, but it's not like private jet type stuff. She's just like, the number is completely meaningless to me. So why would I even bother checking it? And so I saw that and I was like, because I'm on margin, I probably do need to check from time to time.
Don't worry, we're watching for you.
But I was like, wow, because I've definitely felt the need to watch. I've seen my number has stayed flat for 10 years. And I've watched my peers either through extrapolating through their purchases or them just outright telling me, I'm like,
don't extrapolate through purchases.
Oh my God.
Remember.
Yeah, that's right. Oh my God, and I need to reground myself.
Right.
And the freedom to be like, I can't even be upset because I don't even know is something that I've found alluring. So I wonder what you would tell me and others.
Yeah, no, it's interesting. I feel like I used to have I thought it was a funny analogy, or not even analogy, but just anecdotally, 20, 30 years ago, you checked your stocks 40 times a year.
Yep.
You open up the paper on a Sunday and you looked. And I don't know, a bunch of Sundays you were on vacation or busy. So you had 40 observations. It was still the same portfolio of stocks. Whereas now, someone could check it 40 times a day.
Yeah.
And so I think a lot about technology has given us access to observations that are totally unhealthy. And we could argue, you can make this pretty analogous to weight. But I do think that people's ability to interact with their portfolio on their watch, on their iPhone, or any other device you've got, really is the problem. And I shared with you, we do so many illiquid investments, not because it provides us any more compensation. That's just not how we make money. But because I think it provides a different investment return, but more, probably equally as important, it makes it really hard to interact with your portfolio on a daily basis. Like, you can look, but most of this stuff trades every month from a valuation perspective, every quarter. So I actually have found that by having less of the portfolio liquid, because a lot of the founders I work with prior to having their liquidity event, all they own is stocks. So every second of the day, they know exactly what the portfolio has in it. And I think by, having a less liquid portion of the portfolio make up a decent amount, it actually helps with that overall mindset of like, I'll look every month or two because things don't change that often, which is so well aligned with how I'm thinking. So sort of that on its own, I think, helps a lot. And, I have realized, though, that that's pretty jarring. You look, the market's up 3%. You look on your app and you're like, wait, I'm like up like 0.6%. Like, why? Am I doing bad? Am I not doing bad? I don't even know how to think about this. On the flip side, the market's down 3%. You're like, wait, I'm flat today. How could I possibly be flat? And so I realized that I think that it's a superior way to manage real wealth because it makes it, again, enabling, not distracting. I think that technology makes it's like a dopamine hit. We know exactly how that feels. So in some ways, you could almost artificially create an inaccuracy and actually an irrelevance of checking very often by having more or less liquid assets, which in no way is an advertisement to be investing in these things. But I found it's an interesting secondary, tertiary impact, which I think is super aligned to long-termism and not being distracted by sort of day-to-day fluctuation.
I don't have proof for this, but I suspect that there's some paper written about this. There's a reason why the majority of people's wealth is in their house, is because A, there's leverage, but B, you're protected from your worst instincts.
It's the best. If you looked on Zillow every week, and I'm not saying that's right, your house is going up and down a few percent every week.
Yeah. You can't sell it. Like, it's like the furthest spot from your mind.
Don't care.
So you don't care. Yeah. I love that. Oh, but I think what has really come, so much good stuff in this conversation, but what has really hit home for me, and I want to point out to our listeners, is these concepts of non-financial utility and non-financial pain. And I think that as you get on a trajectory of, high earning, making more, investing, the marginal value of the next dollar is just less valuable to you, which means that the non-financial utility of it, by definition, grows, right? Or you have more access to the non-financial. The challenge is that the non-financial utility of money gets really confusing. The healthy ego comes in, the competition comes in, the chip on the shoulder comes in, the scarcity, which kind of brings us full circle, because that's why you said I'm a therapist, right? It's like the money stuff's actually pretty easy.
Yeah, what we're going to do is really easy once I understand why we're doing anything and why we're not doing things. So again, people sometimes get off their first chat with me and they're like, so it wasn't really what I was expecting. We didn't even talk about money. I said, because that's not what we're talking about.
Yeah.
So that's great. I'm glad that you were able to sort of pull together pretty common threads to, I think, every one of the awesome topics you came up with.
Oh, man. Well, Adam, I can't wait for round 3. Thank you, as always,
hopefully people will
your
want round 3.
friendship. And this is just wow. We've been riffing for 80 minutes. So this was awesome.
Awesome.
Thanks,
All right,
buddy.
well, thanks for having me.